Silver, look at where it sits. It is an extreme bargain at just about $40 an ounce because the high in 1980, inflation adjusted, is $1,640. Bam. So moving on, this is, John sent me these recently. This is the Consumer Price Index. This is the original one, the blue line. This is the CPI starting in 1982, where it diverged from the original CPI. And like I said, the truth lies somewhere in the middle. But when I spoke with John, he believes that gold is just corroborating his assumptions because he was an actuary and his models all stopped working after 1982. And he was trying to figure out why something that had worked for years and years and years just suddenly stopped working. And when he investigated it, it was because the government, the Bureau of Labor Statistics, started fiddling with the way that CPI is calculated. This chart here is a couple of months old, but still, gold leads all major assets in 2025. And so we're going to explore some supply-demand here, but I want to show you that correlation economics is showing that retail isn't buying gold and silver. I never make recommendations. I tell people what I do. I don't say buy gold and silver. I just tell you what's happening out there and things you may want to consider. But if you take a look at this, what he's done is he's done a mathematic regression here, and it shows declining sales since 08. It ramped up right after 08, but both gold and silver have been falling in retail sales. And I just, the whole reason I started GoldSilver.com and wrote the books and everything is to try and protect people from government stupidity. And I believe, that I have done some of that. I've made a small difference. So we're going to show some of the demand drivers now. China's new physical gold mandate for insurance companies will reshape the world's gold market. So Avery Goodman, and this is also, this is just a few days old, actually. So, a couple of weeks. China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics.
In a historic move, China's insurance regulator has required major insurers to allocate at least 1% of assets into physical gold. Funded partly by reducing U.S. Treasury exposure, this policy accelerates Beijing's long-term goal of de-dollarization. At today's prices, this mandate could absorb 15 to 20% of global annual mine supply, a seismic demand shock in a market with stagnant production. While rising prices will reduce the percentage impact over time, the structural shift is undeniable. By institutionalizing gold demand, China has effectively weaponized it as both a financial safe haven and a geopolitical tool against dollar dominance.
The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up. Given stagnant mine output and rising institutional demand, gold prices are likely to rise significantly above current historic highs in the coming years. Absolutely. If this demand that is mandated, that insurance companies do this, right now it's 15 to 20% at these prices. But this is like an impossible situation. The prices have to rise for that 1% of their yuan-denominated assets to be allocated toward gold. Moving on, Eric Jung, Indian pension funds might invest in gold. And this is from Bloomberg. India's pension regulator is considering easing investment restrictions after portfolio managers pushed for new ways to boost returns on a rapidly growing pool of retirement money. It's not money, this is currency, and they're trying to turn it into money. According to people familiar with the matter, retirement fund managers met senior officials from the Pension Fund Regulatory and Development Authority in a series of meetings late last month and requested permission to invest in gold ETFs. I wish they would just invest in physical gold.
Beyond China, other nations are also reinforcing gold's monetary role. India's pension regulator is exploring permission for retirement funds to invest in gold ETFs, unlocking vast pools of capital for the sector. Meanwhile, Indonesia is considering curbing gold exports to preserve reserves within its borders. Both developments underscore a trend. Nations increasingly view gold as strategic money rather than just a commodity. In India's case, retirement portfolios could be redefined, while Indonesia's stance reflects a desire to insulate itself from global currency shocks. Together, these policies reshape gold as a pillar of financial sovereignty.
The people said, asking not to be named, and so on. The regulators are considering the proposal and have sent the draft language on gold investments to the funds for feedback. So this is something that is potentially happening, and it's big. Moving on, holy smokes, Eric Jung again, Indonesia looking at reducing gold exports to keep the strategic reserve currency within its own borders. This isn't currency. This is strategic reserve money, and it's the only money. They've got a whole bunch of other fiat currencies as reserves, but this is the only money that they hold, but they want to keep it within their own borders, and this, again, is from Bloomberg. So very legitimate stuff. This is old. This was May 27th, but, Florida signed a bill into a law allowing people to make transactions using gold and silver. So gold and silver is being remonetized. I mean, nobody's doing it yet. Do you have to make them at face value on the coins of $1 for a silver eagle and $50 for a gold eagle, which is crazy? Or can you make them at the current spot price? That would be awesome. Here's the Ron DeSantis announcing it. Gold just broke 500,000 yen in Japan. The yen is getting torched, and gold is going vertical. Japan's debt to GDP is the worst in the developed world. Their only option, print or collapse. Either way, gold wins, and that is absolutely true. And gold in Japan has tripled since the beginning of this chart. In just the last 5 years, gold has tripled in Japan. You may have heard Rick Rule say that global allocation to gold has dropped to 0.5% in recent years, while the multi-decade average is 2%. Now, I've heard and seen measurements where gold was actually 8% of global financial assets when it was in a bubble in 1980.
Momentum is not limited to Asia. In the United States, Florida has legalized gold and silver for transactions, reviving discussions about their role as money. Meanwhile, Japan's currency crisis has propelled gold to record highs of over 500,000 yen per ounce, tripling in value within just 5 years. With Japan's debt to GDP among the worst globally, the government faces a stark choice: print aggressively or face collapse. Either path favors gold. These examples highlight how different regions, whether through law, necessity, or crisis, are reintroducing precious metals into their financial systems at both institutional and grassroots levels.
So a mere reversion to the mean would quadruple investment demand for gold. A reversion to a bubble like 1980 would be 16 times the investment demand. So the price would have to go astronomical. Well, here's the evidence it may be starting. Hong Kong investors triple gold holdings in rush to save haven, according to Hong Kong Shanghai Bank Corporation. Moving on. ShadowStats John Williams hasn't updated for a couple of years. Actually, I spoke with John just a couple of weeks ago, and his website broke a couple of years ago, but he does have a newsletter that he emails out to anybody that signs up, so you may want to sign up for that. And so I reverse engineered his data set and its relation to the CPI and filled in the last 2 years. And the results are eye-popping for gold and silver. And I want to once again thank Nick Laird for doing this. He's done such a spectacular job over the years. You may want to go to his website, goldchartsrus.com, and subscribe, help support his work. But here you've got gold with the Shadow Government Statistics alternate CPI, which I want to remind everybody is just the U.S. government CPI. It's their methodology used from World War II until 1982 when they turned the CPI into the CP lie, and they've been fiddling with it ever since. Now, I do believe that both government methods are wrong and that the truth lies somewhere in the middle, but the original CPI is much closer to the truth than the new CP lie. But this has, you can see that gold is still an extreme bargain, and the Shadow Government Statistics alternate CPI, adjusted for inflation, the 1980 high is $35,454 an ounce, excuse me. And if you want to take a look at silver, this is really something. So,
despite gold's rally, global allocation remains historically low at 0.5% of financial assets compared to the 2% long-term average, or 8% at the 1980 peak. A return to the mean would quadruple demand. ShadowStats inflation-adjusted metrics place gold's fair value above $35,000 an ounce, with silver potentially worth $1,600. These figures expose how official CPI manipulations downplay true inflation. The result, both gold and silver remain deeply undervalued. Investors in Hong Kong have already tripled their holdings, signaling that in times of doubt, markets instinctively revert to the one asset that has preserved wealth for millennia.
Silver, look at where it sits. It is an extreme bargain at just about $40 an ounce because the high in 1980, inflation adjusted, is $1,640. Bam. So moving on, this is, John sent me these recently. This is the Consumer Price Index. This is the original one, the blue line. This is the CP lie starting in 1982, where it diverged from the original CPI. And like I said, the truth lies somewhere in the middle. But when I spoke with John, he believes that gold is just corroborating his assumptions because he was an actuary and his models all stopped working after 1982. And he was trying to figure out why something that had worked for years and years and years just suddenly stopped working. And when he investigated it, it was because the government, the Bureau of Labor Statistics, started fiddling with the way that CPI is calculated. And so he also provides, this has some critical dates. The Federal Reserve, Roosevelt abandoning gold, Nixon closing the gold window, and the CPI reporting alterations started right there. And then he also publishes a much longer term chart, taking it all the way back to the colony, the U.S. colonies, the American colonies, not the U.S. didn't exist yet. 1665. And you can see what happened because of that green dot, the Federal Reserve. Something evil has transpired. Eric Young, again, GLD, gold inventory tonnage versus the gold price ratio at its lows.
The debate over America's own gold reserves has resurfaced, with renewed calls for audits of Fort Knox. Some analysts suggest a radical revaluation strategy, issuing U.S. Treasury bonds backed by physical gold. Former President Trump and high-profile figures like Elon Musk have hinted at gold-backed solutions to restore dollar credibility. Meanwhile, skepticism lingers around paper proxies like GLD as physical gold quietly drains from inventories. Whether through policy reform, market revaluation, or systemic crisis, the path forward seems clear. Gold is no longer a relic, but a necessary anchor for a world adrift in debt and currency risk.
So this is it, and it just shows I don't trust GLD. The price is going up. The tonnage, is sort of flat. That causes the ratio to go down, meaning that the gold price is making new highs while GLD physical gold inventory is hovering at its intermediate lows. Who is sucking physical gold out of GLD? Thanks, Nick Laird, for the wonderful charts. So gold charts are us, or on X, it's Goldfish charts. Moving on, gold revaluation, Trump's red button option. And Trump eyes radical gold idea to expose the Fed and anchor the dollar. And this is about issuing gold-backed U.S. Treasury bonds. Forbes talking about the secret weapon Trump can use to take on the Fed. And he keeps on trying to take on the Fed. The logic of auditing America's gold, the measures reintroduced in Congress, is aimed to restoring confidence in a greenback, the value of which has plummeted below 1/3,300th of an ounce of gold. I'm glad that people are starting to finally state this in the proper terms, that the U.S. dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. It's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing itself. This was a lot of the premise of my first book. Jim Rickards wrote a great article, The Truth About Fort Knox and Gold Leasing, that was on Zero Hedge, but it's the end of the article that is important. The gold leasing scheme. There's another even more insidious reason why Trump and Musk backed off from their Fort Knox visit, even allowing for the fact that the gold is actually in Fort Knox. The deeper question is whether that gold is leased. And yes, it is leased.